If you keep chasing excitement, the market will usually take your money and hand it to someone more patient. Most people do not fail because they are unintelligent. They fail because they cannot sit still. They want action, they want a hot idea, they want the feeling that they are doing something clever. But wealth is rarely built by chasing clever. It is usually built by owning good assets, paying very little in costs, and then giving time room to do the heavy lifting. When people ask me what to buy and hold in 2026, they usually expect something complicated. They expect a hidden sector, they expect a brilliant theme, they expect a list that sounds impressive at a dinner table. But the truth is, the best answer often sounds too simple to be exciting. That is exactly why so few people follow it. And that is also why it works. If I were building a portfolio for someone who wants a calm life, a rational process, and a real chance to build long-term wealth, I would not begin with prediction. I would begin with structure. I would begin with behavior. I would begin with a question most investors avoid. What can you continue to hold when headlines get ugly, when prices fall, and when your emotions try to convince you that discipline is outdated? You do not need dozens of ETFs. You do not need a portfolio that looks sophisticated from the outside. You need a small number of assets that cover a lot of ground, cost very little to own, and allow you to stay invested through different seasons of the market. The fewer moving parts you have, the fewer chances you have to make a bad emotional decision. The first ETF I would look at is a simple S&P 500 fund. In spirit, this is the kind of vehicle I have favored for ordinary investors for a long time. Why? Because it does not ask you to guess which company will win. It asks you to own the strongest large businesses in America as a group. That is an important difference. The average investor gets into trouble when he thinks his future depends on choosing one winner. In reality, long-term wealth usually comes from owning many productive businesses and allowing the exceptional ones to pull the whole portfolio forward. That is why a fund like VOO makes sense as a core holding. It is simple, it is efficient, it is not trying to entertain you, it is designed to let American business work on your behalf. When people wake up, go to work, spend money, build products, ship goods, use software, visit doctors, pay bills, and live their normal lives, large companies capture a share of that economic activity. Over time, ownership matters more than excitement, and an S&P 500 ETF is really a quiet form of ownership. Now, some people will say that sounds too plain. They want something newer. But plain is often what survives. I have seen many fashionable ideas come and go. I have seen investors confuse complexity with intelligence. A simple broad fund can look boring in a bull market when speculative assets are running wild, but boring has a wonderful habit of staying alive. And in investing, staying alive matters. The second ETF I would consider is one that goes even broader than the S&P 500. A total U.S. stock market ETF like VTI gives you large companies, yes, but it also reaches further. It includes mid-sized businesses and smaller ones too. That means you are not only owning the giants of today, you are also giving yourself exposure to the businesses that may grow into something much larger tomorrow. You are buying the full field, not just the brightest part of the stadium. That matters because the future is never handed to us in neat categories. The market leaders of the next 10 or 20 years may not always be the largest names of today. A total market approach gives you a wider net. It reduces the need to be a prophet. And I have always believed that a sound investment process should require less prediction, not more. There is also a psychological advantage here. When you own the whole market, you stop feeling pressure to constantly compare one company against another. You stop asking yourself whether you missed the next big thing. You already own a piece of almost everything that matters. That can bring a tremendous amount of peace. And peace is useful in investing because peace keeps you from making expensive decisions at the worst possible times. Now, I want to be clear. I'm not saying you must hold both an S&P 500 fund and a total market fund in equal size and call it a day. I am saying these are the kinds of ETFs I trust because they are built on breadth, low friction, and realism. One gives you concentrated exposure to America's biggest engines. The other gives you the broader American machine. Both reward patience more than prediction. The third ETF is the one many people ignore when the market is rising and suddenly wish they had when the market is falling. That is a broad bond fund like BND. People like to think bonds are unnecessary when stocks have been treating them well. That is a little like saying you do not need brakes because your car is moving nicely on a straight road. You only discover the value of stability when conditions change. A bond ETF is not there to make your portfolio look exciting. It is there to make your behavior more stable. And behavior is what usually determines whether a plan succeeds. If all of your money is in stocks, there will come a moment when the market falls hard enough to test your confidence. At that moment, a bond allocation can do something very important. It can reduce the pressure to sell your stocks at the wrong time. It can give you liquidity. It can give you emotional balance. It can help you remain an owner when others are becoming fearful. This is where most investors misunderstand risk. They think risk is only about return. It is not. Real risk is also about what you will do when discomfort arrives. A perfect portfolio on paper is useless if it causes you to panic in practice. A slightly less aggressive portfolio that you can actually hold for 10 or 15 years may produce a far better real-world outcome than an aggressive one you abandon during the first serious storm. So, when I think about 3 ETFs to buy and hold in 2026, I do not think about trends. I think about function. I think about a core engine for large American business. I think about broad exposure to the full U.S. market. And I think about an anchor that helps an investor stay rational when fear enters the room. That is a far better foundation than trying to jump from story to story every 6 months. The market will always tempt you with noise. It will offer urgency. It will offer opinions. It will offer endless reasons to tinker. But a good portfolio should not need constant attention to prove its worth. A good portfolio should let you get on with your life. It should let you work, save, raise a family, build a business, read, think, and sleep at night. That, to me, is one of the finest tests of a sound investment plan. But owning the right ETFs is only the beginning. The real difference comes from how you hold them. A sound portfolio is not just a collection of assets. It is a system for protecting you from your own impulses. That is why allocation matters. That is why expectation matters. And that is why most people sabotage a good plan long before the plan has time to reward them. If I were speaking to an ordinary investor, I would begin with a very simple idea. Let your stock ETFs do most of the growing. Let your bond ETF do most of the stabilizing. That is the basic job description. Stocks are there to build wealth. Bonds are there to help you keep your discipline. Once you understand that, you stop asking each holding to do the wrong job. A younger investor with steady income, a long horizon, and the ability to stay calm might lean heavily toward the stock side. That could mean making the S&P 500 or the total market fund the large majority of the portfolio with a smaller portion in bonds. Not because bonds are weak, but because time gives stocks more room to recover from setbacks and compound over long periods. The younger you are, the more valuable time becomes. And time is the friend of productive assets. But even then, I would not underestimate the value of stability. Many people believe they can handle volatility until volatility actually arrives. They imagine themselves calm during a 50% decline because they have only seen such declines in history books or charts. That is very different from watching your own savings shrink while the world tells you disaster is normal. A modest bond allocation can keep a difficult season from turning into a permanent mistake. For someone closer to retirement or someone who simply knows his temperament, the bond allocation becomes even more important. There is no prize for owning more risk than your stomach can bear. A portfolio should fit the investor, not impress a stranger. That may sound obvious, but most of the damage in investing comes from people building a plan for the version of themselves they wish they were, rather than the version they really are. There is also the matter of overlap. If you own an S&P 500 fund and a total U.S. market fund together, you should understand that they share many of the same large companies. That does not make the combination wrong. It simply means you should know why you are using both. Some people prefer to choose one as the stock core and keep things cleaner. Others may blend them because they want heavy exposure to large businesses while still reaching into the full market. The point is not perfection. The point is intentionality. That word matters. Intentionality. A great many investors own things accidentally. They buy one ETF because someone online mentioned it. They buy another because it had a good year. They add a third because it sounds sophisticated. Before long, they no longer have a portfolio. They have a pile. And a pile is difficult to trust when markets become difficult. A portfolio built on purpose is much easier to hold. Now, let me tell you where the real enemy usually appears. It is not in the ETF itself. It is in the mirror. It is the urge to improve a plan that was already good enough. It is the desire to add a little excitement. It is the restlessness that whispers that simple must be outdated. That whisper has cost investors a fortune. A low-cost, broad ETF portfolio often fails to feel rewarding in the short run because it does not produce daily drama. You will not wake up every morning feeling like a genius. You will not have an exciting story for every market move. You will simply own productive assets and continue buying over time. That sounds ordinary, but ordinary, repeated patiently, can become extraordinary. That is why consistency matters more than timing for most people. The investor who keeps adding money month after month into strong, broad funds is often in a better position than the investor who spends years waiting for the perfect entry point. People love the fantasy of buying at exactly the right time. Real wealth is more often built by buying at many reasonable times and refusing to be shaken out. This is especially important when prices fall. A falling market does not automatically mean your plan is broken. Quite often it means your emotions are louder than your logic. If the businesses inside your ETFs are still productive, if the costs are still low, if your time horizon is still long, then a decline may simply be the price of admission for future returns. The market has always charged an emotional fee. The people who build wealth are often the people willing to pay it. And that brings me to another quiet truth. The best ETF portfolio is not the one with the highest possible return on paper. It is the one you can continue to fund, continue to trust, and continue to hold when the world feels uncertain. That is why simplicity has power. Simplicity reduces the number of decisions. Fewer decisions mean fewer mistakes. Fewer mistakes mean more compounding. People often search for better products when what they really need is better behavior. So if I had to reduce this whole idea to a few practical principles, it would look something like this. Own a broad stock fund that gives you exposure to strong American business. Own a broad market fund if you want even wider participation across the U.S. economy. Own a broad bond fund. So your judgment stays steady when stock prices do not. Keep costs low, add money regularly. Do not interrupt compounding just because fear has become fashionable. There is something deeply comforting about a portfolio that makes sense in quiet times and in difficult ones. You do not need to guess what the economy will do next quarter. You do not need to predict which headline will dominate next month. You do not need to build your future on the hope that you can outsmart millions of other people every single year. You need a rational structure and the character to stay with it. That, in the end, is what buy and hold really means. It does not mean blind stubbornness. It means thoughtful commitment. It means choosing assets for the right reasons then giving those reasons enough time to prove themselves. It means understanding that patience is not passive. Patience is active restraint. It is discipline under pressure. It is the willingness to look unexciting while your wealth is quietly being built. Most people want investing to feel dramatic. I have found that the best results usually come from making it feel almost boring. Not careless, not lazy, just calm enough to think clearly, calm enough to ignore noise, calm enough to let time and good assets do their work. And if you can learn that lesson, you will already be ahead of many investors who spend their lives searching for the next big thing while ignoring the durable power of the right small number of things. And if you can hold that lesson through good years and bad ones, then these ETFs will not just sit in your account. They will become part of a wiser way of thinking about money, risk, and life. Because the goal is never just to own investments. The goal is to build a life where money serves judgment, not emotion. A life where your portfolio supports your peace rather than disturbs it. A life where you do not need constant excitement to feel progress. That is the kind of wealth worth holding.